Okay, while we're, in case anyone else is getting ready to join, I thought I'd tell a quick story about a shepherd and his dog who were out tending their flock. And down the road came this really nice sports car convertible, brand new, high end. And it screeches to a stop near where he was standing. And out pops a very well dressed young man, and with designer sunglasses, comes up to the shepherd, and he says, "Hey, I just wanted to introduce myself, and I see you're herding some sheep here, and I wanted to know if I could tell you and give you a written report of how many sheep you have, how many males, females, what type of sheep they are, and all facts about your sheep. If I did that for you and I could do it in the next 5 minutes, would you give me one of your sheep?" And the shepherd was very amused, and he said, "Sure, why not?" And so the young man went back to his vehicle, pulled out his iPad, starts pulling down global positioning satellites, and he comes out. He's got a printer in his car, and he comes out with a full report. And he says, "You have 93 sheep, 84 are ewes. There's 9 rams, 43 are blue-faced Leicesters, 27 Romney, 14 Cotswold, 9 Shetland, and by the way, 7 of your ewes are expecting lambs." And the shepherd was kind of impressed. And he said, "Well, you go ahead and take one of the sheep, and it's yours." And so he makes his choice, and he goes and he puts the animal in his car. And the shepherd says, "But you need to give me a chance to get even with you." And he said, "If I can guess your occupation, can I have my animal back?" And the young man says, "Well, that's fair." And the shepherd says, "You're a consultant, obviously." And he says, "How do you know I'm a consultant?" He said, "Well, you showed up here even though you weren't invited. You asked me questions that I already knew the answers to, that I didn't even ask, and you don't know anything about my business. So would you please go and get my dog out of your car?" So usually I hear laughs at that, but I think everybody's on mute. So hopefully that got a chuckle. And the point of this story is, not that all consultants are bad, but if you use someone that knows your business, use someone that's in the industry, and that knows a little bit about what you're doing. Okay, moving on to the actual presentation. We're going to talk about a couple of areas of focus, and the presentation is about setting up measurements and understanding how to measure your business so you can manage it better. We do that through trend analysis, taking a look at trends in the business. So we're going to get into gallons, margins, gross profit, operating expense, and capital expenditures. I'll touch on that at the end. Um, just some definitions. EBITDA is a commonly used term, earnings before interest, taxes, depreciation, amortization, otherwise known as operating income. We define that, and I'm going to say that a couple of times because we define things a little differently than some accountants, as gross profit minus operating expenses. And gross profit in our mind is gallons times margin, or revenues, particularly service revenues, minus cost of goods sold. So gallon adjustments, everyone measures gallons differently, and that's fine. Just remember to be consistent year to year, however you measure your gallons. Some of the common categories, residential, commercial, agricultural, wholesale, reseller, auto, gas. Cylinder exchange sometimes is measured in gallons, sometimes it's measured in units, mostly units, but we've seen it as gallons also. So I want to mention that. Okay, so I want to give you an example of one of our clients who we looked at their business, and just looking at the residential segment of their business, we saw that they had a big growth in 2018, and then they trailed off pretty heavily in 19 and 20, and you can see the growth rates, negative less than 100 is an attrition rate. So this raised some questions as to what was going on there. Was it a one-time deal, or what did they do, an acquisition or whatever in 18. So we ran a trend analysis on it, and using a 4-year average growth rate, it looked like this company was, was slowly losing business, and that at the end of 2024, they'd have around 3.6 million gallons of residential business left. But this was in a cold weather climate. So we wanted to do our degree day adjustments. It was almost 6,000 degree days in this particular area. And so we looked at the degree days, and we saw there was a substantial variance. In 2018 was definitely colder than normal. Propane, it's difficult sometimes to do degree day adjustments. And the reason is because so much propane is not used for heating. So it's, we look at the summer months, June, July, August. Some of those gallons may come from heating, from the tank that was filled earlier, but that gives us a pretty general idea. This particular company, about 70% of their gallons were from heating. We adjusted 70% of the degree days. And on the very bottom section there, you can see that the company didn't have attrition. They actually had slight growth and went down a little bit in 2019. So what does that mean? So if you take a look at the 4-year, if you just did average gallons, average trend versus the weather adjusted trend, in 4 years, there's a 700,000 gallon difference. So that makes a big difference in your business. So we always recommend to weather adjust, get the best handle as you can on how many of your gallons are weather related. Now, there's other areas of the business that have to be adjusted also. Agricultural is the most obvious one. It's weather dependent. A lot of it's used for crop drying. So how do you project it? How do you know what you did last year, whether that had a lot of crop drying, a little crop drying? We usually just take an average. We try to get at least 4 years, maybe 5 years, to try to project what's going to happen in the future. We do these projections mostly for business valuations or for presenting companies' businesses on the market. Wholesales, and we'll see in one of our samples, usually, there's not a lot of the gallons, and not a lot of customers make up those gallons, so they're a little easier to project. Bids, now you see it, now you don't, unless they're very regular bid accounts. Reseller pump station and cylinder exchange, I'll put them together because we saw this past year those numbers just spiked with COVID and people filling up barbecue tanks. We talked to a company who does a lot in New York City, and they told me this past fall compared to the prior year, their numbers were up 300% because of all the outdoor space heating that the restaurants were doing. So you have to normalize for that when you look at projections. Commercial, we saw some drops, people that had restaurants and things like that. Again, a little difficult. You got to know your business in order to do your projections. Generators, good luck, hard to plan for. I have a generator at my house. 9 days in 2020, we had no electricity. Therefore, my propane usage, I'm sure my supply was very happy, but it was almost 4 times what it normally is. Okay, income statements and P&L as they relate to gallons. I've heard this, hey, what's up? Gallons are not on an income statement. And my response is, well, they should be to analyze your business. You can call the income statement a financial analysis if it makes you feel better. We had one client, very interesting. I got their income statement and they had gallons on it. And I was like, how did they do that? And what they did is they put $1 a gallon for every gallon in the various categories. And then they had an offsetting category, negative $1 a gallon, to take it out of the financial aspect. But by having it on the income statement, it then allowed you to figure your margins out a lot easier. It allowed you to do other certain measurements. So we were very pleased to see that. You don't necessarily need to do that, but it's nice to have. Everybody tracks gallons, but not everybody tracks them on an income statement. And when you put them on an income statement, it makes it for a really nice financial analysis. Okay, so I'm going to talk about a sample of a company here. This company has broken their gallons into propane residential, propane wholesale, and propane commercial. And so we looked at this company, and on the left are the year over year changes. On the right of the gallons. So between 17 and 18, they grew 2.1%. Between 18 and 19, they grew 1.1% over on this left here. Then 1.4% between 19 and 20, and they averaged 2.5%. That's what 102.5 stands for. We thought that was a little aggressive on the average because of COVID this past year. So we went in with a 2% increase in gallons moving forward. On the wholesale side, you see they dropped off substantially in 19 and 20. And we found out that was because of one large customer that they lost, and they felt they were going to be pretty good with the rest of their business. So we left it flat after that, even though they had attrition. On the commercial, again, we had up and down, up and down. We took a 4-year average and went with a little less than 1% attrition for projecting it out. Using those projections, using those numbers, we came up with projections. And now we have a better feel for what the business is going to be doing moving forward. If you're valuing a business, it's not just what they've done, it's what the trend is, what they're looking to do in the future. I spent a lot of my career on the buy side. We would always do projections, 4 to 5 year projections. We were concerned about what the company made, but we're more concerned about what are we going to make? What's our attrition going to be? What are our expenses going to be? So as a buyer, the buyer tends to do their own modeling. As someone who represents companies for sale, we try to do reasonable models that show the company in the best light. Okay, service, the service side of the business, non-fuel, non-propane related. So in this particular situation, we had this big bump up in service in 2019 and 2020, and that just looked very odd. So we asked the owner, what was up with that? And they said, oh, we purchased an HVAC company because we always felt that we weren't able to get the margin that we wanted on our products unless we offered the service. Similar, and the heating oil industry is a lot like that. But we find propane companies don't have that HVAC focus. But this company felt it was important. They also did it as a diversification of to bring in other revenue sources. And it worked pretty well for them. They did go down in labor and materials. And we think a lot of that was COVID related, that it'll pop back. Service contracts were interesting. They had really good growth there, 22.5% growth. But you got to be careful. Small numbers can be deceiving. They're not going to keep 22.5% growth up for 4 years. That number should slow. They're probably still promoting service contracts, and they'll get some of them. So we did it at a 10% growth rate. On the this is where we get in. I show the total service, and this is another thing I like to look at the bottom line sometimes on the totals. 2019 was a great year. They bought that HVAC company. 2020 came down, probably COVID related. Then I looked to 2021, and our projections were just a little better than 2020. So we left it there to be conservative, but that's something we would keep an eye on because it could pop right back up to those other numbers, and then we'll have a better number when we get to the end of the 4 years. So just a side note. Cost of goods sold, and I put from a financial analyst point of view, we get so many financial statements from accountants, and the only thing on there is that bottom line, total cost of goods sold. And then we always have to ask for a breakout. So then they dig into the QuickBooks reports, typically QuickBooks or whatever they use, and to get us a breakout. We need to know what the profitability is for each segment of the business, whether it's residential, wholesale, commercial, and on the cost per gallon. One difficult thing here is like agricultural is a good, the price of propane could really fluctuate. It could fluctuate 50 cents in a year or more. And so it's very difficult to say what the cost was for wholesale versus commercial versus agricultural. Um, I guess it's possible, but we just use an average for the year and we use that same cost per gallon for all segments of the business. Um, Installations, again, we see the gross profit went up there. And just overall in this business, the cost of goods sold actually went down. And the big driver of that was propane went down $1 million because of the cost down to 108 from 126, then 127 the prior year. Okay, some accounting reports will include direct operating expenses and cost of goods sold. We see that a lot. They take the cost of fuel, and then they take the driver's wages, truck fuel, truck repair, and they put it all in cost of goods sold. Some of your better accountants who work in the industry don't do that. I shouldn't say better, some who are more familiar with the industry. If that's the way your accountant does it, you really need to back that out because you can't do margins without it. So we take it all out and put it down into operating expenses and leave it as cost of goods sold is pure propane product that you're purchasing, or it is on the service side, it is parts cost. We don't put any labor in there. I mean, you can do that to find out the profitability of that particular business segment, but not for general financial analysis. Okay, so in this company's example, we look at the gross profit breakout. Gross profit tells us a lot about the business, much more so than revenue. So we see that big jump from 18 to 19, actually went down a little, 17 to 18, and then another jump in 20. And that appears to be on the residential side. We also saw the installation numbers go up, and that we talked about from that company they acquired. So the total gross profit took a pretty good jump. But then look at the total sales revenue on the bottom. Total sales revenue went up a little bit, but then it went down in 2020. And I can't tell you how often we're in due diligence, and we've had some of the biggest auditing firms in the country, and they inevitably, they come in and they do this quality of earnings review, especially on the bigger transactions. And almost always they say to us, well, how could that be that gross profit is up when your revenues are down? Because so many businesses are analyzed on revenues, and we have to explain to them that this is a commodity-based business, and you can't look at revenues. You have to look at gross profit. And so that's, that's one of the items I wanted to point out. The margin analysis. Almost everybody does one. I'd like to have it right in the income statement as a supplement on the bottom or somewhere in the income statement. So you can understand average selling price is fairly easy. If you have your class as a business, you know what you charge them. There's your average selling price by class, by how you have them grouped in your computer. Again, the cost of propane stays the same. You have no control over the cost of propane. The only control you have over average selling price is the margin, because margin plus cost of product gives you your selling price. You can see in this example, the price had actually gone down in 2018, and then it went up to 141 in 2019, and that's why we see the big jump. We later found out some of that had to do with some purchasing mistakes that were made. But in general, they goosed the margins a little bit when they had the full service business. The service margin, you can see that also went up from 33%, 30% up to 36%, and then came off a little bit. That was a result of that acquisition. Okay, digging in a little bit deeper. So how do you project this out? On the residential propane, way over to the left, the margin went down 6 cents. It went up 14 cents. It went up 6.7 cents. It averaged 4.9 cent increase. We think some of the 2020 average selling price at 148, we think that was due to the lower cost of product, people holding on to their margin. a little bit of, COVID related, possibly. So rather than, we were going to do a 1 cent a gallon increase a year, you need to have an increase to offset your increased operating expenses. We'll get into that. So we did an average. We did a 2-year average and projecting 2021 at 144.93. Then we went up a penny a year after that. On the installation revenue, we did the same thing. We felt we couldn't use a 4-year average on that. It just didn't make sense. We knew that was going to pop a little. I'm sorry. This is with a 4-year average, the 34.1. But we know we have some room there that we could make that a little bit higher. Because more than likely you'll never see the 30% range again. Okay, so I want to relate that to EBITDA because that's one of the most important aspects that we're looking at here. So you can see there was a steady upturn in EBITDA with big pop in 19 and 20, which is great. But then we see it come back off in 21. Again, a lot of that's margin related. And then it actually continues to go down, which is not a good sign, even though the gross profit goes up. But what's happening is the operating expenses are going up faster than the gross profit's going up. So that's something this is one of the main reasons why companies should do projections, is to make sure that they're keeping pace with the operating expense inflation. And we're going to get into that. But first, what I did in this example is I said, you know what? Let's do 3 cent a gallon increase. That's what we typically look for in the residential propane market. And on the commercial, they were pretty steady at around 2 cents. So we brought that to 2 cents also. And there's the installation at 36.1. We did a 2-year average. By making those changes, you can see that this gives you an upward curve to your projected EBITDA as it slowly goes up. So that's what companies want to do. They want to, worst cases, stay where they were last year. Best cases, continue to grow their business and make it more profitable. And doing projections is the tool that you can use to accomplish that. This is just a comparison of those two. The one on the top is where EBITDA is going down, and the one on the bottom is where EBITDA is going up. And all we did was change a couple of items: residential, propane margin increases, commercial, and then the service margin. Okay, I want to get into operating expenses a little. There are actually a few ways you can do operating expenses. If it's related to delivery, like delivery wages, usually it's on a per gallon basis. The HVAC and service is usually revenue based on the projected sales revenue on those items. Items like bad debt, bank service charges, credit card fees. Easiest one to understand is credit card fees. Credit card fees are a function of total revenue of the business. If you're paying 0.5% on average of your revenue, if the price of propane goes up, you're paying it on a higher amount on the revenues you're generating. Some are inflation adjusted. People like to get raises every year, so wages tend to go up, regular office wages. Insurances tend to go up. We'll get into some details there. This particular customer, client, regulatory and compliance, telephone and communications have gone up, tax expenses, property taxes have gone up, and some expenses a little bit all over the board. The tires is a great example. One year it's $20,000, one year it's $8,000 because they decided to put tires on. One year they did a whole bunch of trucks. So those we usually average, and I'll give you some examples. I want to talk about wages a little bit, and so I don't completely bore you to death with numbers. I'm going to tell another story. It happened to me when I was probably my first or second year doing acquisitions, working for a large multi-state marketer, and we had a company. It was around $1 million transaction. It was mostly heating oil. The EBITDA multiple was fairly low, 3.5 to 4. We got the letter of intent is signed. The final documents are with the attorneys. We're getting ready to close on a Thursday. I think it was Thursday. And Tuesday, I get a call from the owner. His two sons work for the business. And we put their wages at our top wage earner was $21 an hour. And he calls me up and he says, Steve, I really want to do something for my sons. They're not really good at, they wouldn't have been good at running the business, but I want to make sure they're taken care of. Can you pay him $25 an hour? And I said, well, let me see. I think it's going to affect our financial model. So I went back, I crunched the numbers. We were owned by a public utility company at the time. So I had to do, a lot of number crunching for them. And I found out for every dollar an hour per son, it reduced the purchase price by $12,500. So $4 an hour each reduced the purchase price by $100,000 on $1 million transaction. So I went back to the owner and I said, to keep the math even, I explained how multiples work. And I said, I'd have to reduce your purchase price by $100,000 if I give both your sons a $4 an hour raise. And so he thought about it for a minute. And he came back and he said, what's the least you can pay them? And I thought that was very interesting. We ended up leaving it right where it was. But he got it. He understood. If we paid him $4 less, we could pay him another $100,000 for the business. But it didn't work out that way. We had the right number to begin with. So I wanted to tell that story because wages make up, in this particular company, this is a little higher than I normally see, but 50% of the operating expense. And that doesn't even include the benefit load. So it's the number one area where people, look to save and can save. What's happened in the delivery side of the business, and what I did is I've been putting the projections to the left side, but on delivery, I put it underneath because the gallons change every year. So I wanted to show that it was 8.5 cents a gallon in 2017, and it was almost 10 cents in 2020. That's a big number. Down here is the actual percentages per year of that increase. And we have seen this across the board. We've seen this pressure on driver wages with the shortage of drivers out there. We've seen it on the service side also. So when we do projections now, we want to project a higher amount per gallon. Again, gallons, you deliver more gallons, you're going to have to pay more. So that's how we ran our projections. You'll see them go up substantially. That's because gallons go up a little bit, but wages are going up quite a bit here. HVAC and service, again, we do that off of revenue. We also used we used a percentage of revenue where we were. We actually, this is a little deceiving. We actually used the 5% increase in their wages as well on top of the revenue projections, but you can't see that on this spreadsheet. It's a hidden formula. Sales department, we did the average 0.003 and then the same on the administrative. Okay, then you have certain expenses that are wage related. I mentioned a couple of them. Payroll tax, profit sharing, and benefit load. These are all grouped together here. So we've also seen that there's been increases. So when you project out, you need to see what, like, wages, payroll taxes have been going up. Profit sharing has been up and down, so we used an average. And then this benefit load, which I'm not exactly sure everything that's in there. I didn't unpack this to find out what flows into that, but it's been going up every year. So we used a projection of a penny, not the average, because in 2020 it was almost a penny. So you got to look at what the trends are. That's why this program talks about trend analysis. Then there were certain revenue-related expenses. This is where the auditors are right. If revenue goes up, these expenses should go up. Bad debt, bank service charges, credit card fees is the easiest one to understand. Um, Bad debt is one that is interesting because they had 30.33, a third of a percent of bad debt. Then they had technically none, or it wouldn't carry out that far, 0.02, 0.07. People take bad debt when they need it. They reserve for it. And then when they want to take the tax break, or if they have to write something off, they write it off. Otherwise, they kind of bank it. So for doing projections, we usually use somewhere between 0.25 and 0.5. In this particular one, I use 0.35% for bad debt. Bank service charges, we used what the average was, and credit card fees have been increasing. I thought 0.72% of revenue was high. It could be good news, it could be bad news. My first question when I see this is, do you take American Express? Because American Express tends to have a much higher rate. But people might be promoting credit cards to have lower bank fees, and these bank fees actually look pretty low comparatively. So for cash flow purposes, they might be promoting credit cards. So it might not be a bad story, but it is increasing. I highly recommend to any owners of businesses that they speak with some credit card processing companies. We've seen numbers come down here. These gateway fees have greatly been reduced with certain processors. So it's something you want to look at. The other thing with credit cards is, in a transition of a business, check your credit card agreement. Check to see that you own the credit card numbers in the data vault. Many a time we get down in a transaction and the credit card company says, we're not going to give you the credit card numbers because we own them and we want the new buyer to deal with us. So they have to deal with us, so they have to call all the customers and get new credit card numbers. It's something we usually get involved with in the negotiations, and a lot of times they'll relent or they'll hold you for ransom a little bit, so you don't have to call every customer to get a new credit card number. You can negotiate that in your credit card, your contract with your credit card company. So try to make sure you actually own your data vault. These are some inflationary expenses. I highlighted a couple, just oddities. Why would advertising and promotion go down? So we'd want to look at that a little bit. The legal and professional, we found out it was a one-time, this was a one-time fee, so we adjusted it off. We have adjustments at the end. The insurance, I love the insurance line. 333,000, 235,000. One of the reasons for the jump in EBITDA. The answer is they shopped it. They were with someone forever. They had a good relationship with the insurance agent, and then they decided to shop it, and they saved quite a bit of money doing that. And then it slowly works itself back up again. We see this more than once. This could also be the fact that they might have had a bad rating, and that it worked itself off and the rating came back down. Increases could be as a result of that too, but this was because they shopped their rate. Auto and truck, these numbers look first, rent was flat because it's a related party. Postage and delivery, we had deflation. We had a very solid decline in postage and delivery, and that is because they really get more and more people on electronic billing. So I thought that was interesting. Auto and truck, when we see expenses like this, we start digging. Inevitably, we'll find truck repairs that really could have been capitalized. Really no reason, I guess there's always reasons to do it, but we would dig and take that out and call that a capital expenditure, and we would take it out of, and it would cause the EBITDA to go up if we did financial modeling. But you just want to recognize that. So that's pretty much the balance sheet and the bottom line that brings it to your EBITDA numbers. But I want to talk a little bit about cost benefit analysis. I'm a big believer in investing in technology, and I think that the one particular item that I've seen that I'm just an advocate of is tank monitoring. I think tank monitoring can absolutely lower delivery costs, especially in a time when it's difficult to find drivers. I saw a program called Adept, and it kind of blew me away because it combined tank monitoring with like K factor and other delivery metrics uh, to where I go back to early in my career when I ran a branch for a large company, and when it would get really cold out, I would go into dispatch, and I would work with the delivery manager and the dispatcher, and we'd be pulling tickets out of the rack. And anybody who had a high K, meaning they didn't burn as much fuel per degree day, we would pull them out, and because the drivers just had a tendency to take 30, 40, 50 tickets and then bring back whatever. We needed them to take the right tickets, or otherwise people were going to start running out. Whether you're on K Factor or whether it's on periodic deliveries, there's ways you can manage that. And these new systems, these new software packages, these tank monitoring, I mean, that just does that for you, and it does it so much more efficiently than three guys in there at 9 o'clock at night pulling tickets out of a rack to see what they're going to give to the driver the next day. So anyhow, this particular example is from a client of ours that we just closed on this year. And it was just so much of a glaring example of cost benefit analysis, and I wanted to share it with you. This company was driving 60 miles each way to load their bobtails. They'd been trying, it was a fairly new company. The company is only 9 or 10 years old. And they'd been trying for a few years to put in a tank and having a lot of issues with the town, getting permits. They finally got a spot. They put in a tank. They were also buying from secondary suppliers instead of the major suppliers who could truck it in. So they installed this tank, and it cost them around $275,000. They actually didn't have that kind of cash laying around, so they used one of the industry leasing companies, very well-known company in our industry, and it worked out to be a great investment for them. Within 2 years, they had close to all of it paid off within the third year. They only put this in a year before, so they would have gotten it paid off in 2 years. They actually paid off itself a lot quicker because the difference in the improved EBITDA times the EBITDA multiple increased the value of the company by $830,000. So they got more than 3 times back what they invested in that tank. So just to show you the math, they had done it in 2018, 750 EBITDA, then 19, 775. With the new tank in place, they were at 915. So we went back, and you can go back legitimately and say, well, what would the company have made now that the tank's in place? So we figured that the impact on the gross profit was about 6 cents a gallon on improved purchasing. And then we took 20% of the driver wages, fuel expense, 10% of repair expenses to the trucks. And we thought that was conservative. And with those savings of 115, 118,000 a year, we were able to show that really the EBITDA would have been 867, 895, and now it was 915. So that's a situation where there's a huge cost benefit analysis. Right now, with bonus depreciation and accelerated depreciation, it's a great time to invest in infrastructure and hard assets. You can write it off, you get an immediate tax break, and that's great. The bonus is gonna phase out over the next 5 years, and we don't know what's happening with the other tax laws, but right now that's what's scheduled. Okay, just quick note on paralysis by analysis. I had a boss, and He always had his door open to his office, and he was always working on his computer, and he loved Microsoft Excel, and he loved crunching numbers on spreadsheets. So we would either walk by his office really, really fast, or we would tiptoe past his office if he wasn't, if we thought he wouldn't catch us by the corner of his eyes. Because if he got you, you were in there for at least 2 hours looking at spreadsheets. Learned a lot from the man. He was really good. He knew his stuff, but he did so much. It just, it took you away from the running of your business. So be careful. And I had an example. I ran into an example with a client of mine, and I just wanted to share that with you. This is a company who wanted to understand their profitability by many different categories. This is just their wages they had on their income statement. Um, Propane oil, propane service, oil service, propane installation, oil installation, propane tank installation. And they had it all broken out by admin wages, by dispatch wages, service wages, um, 24 different categories. I went back and looked this up. I remembered it was a lot. They only have 14 employees, and they had 24 different categories. Now, I understand people wanting to understand what their profitability is per area, but this was almost impossible. Every month, they would spend hours upon hours allocating between these departments. How much this month, how much that month, and they lost sight of the business. So that's just a little bit of warning when you analyze your business. Understanding financial reporting versus accounting. I've talked about this a couple of times. Accountant's main function is to put your information in a format that you're paying the proper taxes. Financial analysts' main function is to give you the tools that you need to understand your business and help manage it better, measure to manage. But I did find this one definition that I found very interesting. It was an accountant is someone who solves a problem you didn't know you had in a way you don't understand, as opposed to a financial analyst who's an expert who'll know tomorrow why the things they projected yesterday didn't happen today. So with that said, I will open it up to questions. The first one we have is, how has COVID affected projections? I talked about a couple of those things. We see on the service side, we're actually right now in the process of getting a hearth company ready to put on the market. And it was very interesting when you look at their month over month sales and how they just took a dive in April, May, and June. And now they've come back to be higher than they were the prior year as people are investing in their homes. So you really got to, unpack your business to understand that a little bit better. We've also seen lower cost of fuel, particularly in March and April, which led to higher margins. Again, this thing isn't over yet. If it affects your employees, it's going to have a different effect. Commercial restaurants, if you're in an area that does hotels or theme parks or things like that, then you have to kind of take a look at that. Okay, we have another question. The Green New Deal, with the Green New Deal on the horizon, how do you think values will be affected? I've been asked that question probably 3 times a day for the last week. And of course, it's difficult to do any kind of projection based on laws that haven't quite changed yet. It's a very aggressive program, doing away with hydrocarbons, and all electric cars by 2035 in California is the latest that we've heard. I think propane has got a great shot at hanging in there. I mean, probably all the politicians have propane generators at their house. So I would think that's going to be in our favor. If you don't have propane as a backup for the electric, I don't know what happens to the country. I don't know of any green fuels. I know we're talking about some renewable propane, but that still seems on the horizon. It's something to be very cautious about. The costs may go up, but I don't see how everybody switches off that. The heating oil sector has biofuels. Again, we're just going to have to see how it plays out. As far as how it's affected values, we haven't seen much of an effect. There's still a lot of buyers out there, um, you know. So I would say, stay tuned. There's no real changes yet, but we're being cautious. Okay, next question. I hear about companies being valued based on a multiple of EBITDA. What is the current multiple, and do you think it will change? Okay, that's a good question. To understand this, I have to understand the value drivers for EBITDA. There's all different multiples. In the propane industry, tank ownership, tank control, as it's sometimes called, is one of the main drivers of this business. Demographic area. There's so many. Automatic delivery versus will call. We saw with that one particular client that we had that actually service was a value driver. It drove up the value of their business through increased margins. So it really depends on the business, and the multiples will range. The other big one is the size of the company. If you have a $200,000 EBITDA company versus a $2 million EBITDA company, you might see the difference between 5.5 and 8.5 on the multiple. So that makes a difference. Doesn't include vehicles. Are the vehicles new? Doesn't include real estate. Doesn't include storage tanks. Propane storage is big. So all of those things feed into that multiple. It's kind of done on an individual basis. So that's pretty much what I had. I think it's important to measure your businesses to understand what's happened to them, what's going to happen. The trick here, or the trick or skill or whatever it is to really understand your business. Propane is unlike other businesses because the demand, generators is the best example. How do you deal with that? Just a quick story about a friend of mine who owns a business in Connecticut. We personally were out of power for 6 days, and his whole area got hit really hard back in August. And so he got on the phone with some other companies he knew in the industry. And this goes to associations and the power of an association. Is he called people he knew who were members, and he got them to send trucks and drivers, and they put them up in hotels. I think he had 4 or 5 of them that were there to service his generator customers because he was getting just slammed with generator business. So those type of things, being creative, being prepared for the worst, are the type of things that make between a good business and a great business. Any other questions anybody has?
Hey, Steve. How does the AR and the accounts balances over certain ages affect the value of the businesses?
That is an excellent question, and coming from the AR queen, I appreciate the question. As in your business, you handle this all the time, and it goes to quality. It goes to quality of the business. So when we talk about EBITDA multiples and drivers, every buyer looks at the accounts receivable. And if they see a lot of stuff over 120, over 90 with poor payment and collections history, they're discounting the value of that company. The way they make offers, some people buy the receivables at a discount. Some people do collect and remit. Some do a combination of both. But it is absolutely goes to the quality of the customer deck, is how well the receivables are handled and collected. Melissa, a company like yours, people who have any kind of an issue with accounts receivable, they need to be reaching out to you to get better processes in place, to show better collections. They should be doing it anyhow, but if they're looking to market their business in the next couple of years, it's that much more important for them to do that.
Yeah, I think it's a matter of sustainability, in today's, uh, you know, with the epidemic. I mean, we've survived a year, almost a year of it, but who knows how long. The outreach to the customers is going to be imperative. So my next question is, when dealers are looking to sell, and the acquisition company, or the company who is looking to acquire them, are looking at this. When you said, they'll buy the receivables, is it pennies on the dollar? What are we looking at?
There's a factoring schedule. Normally runs between like 93 and 97% of current. 30 to 60, I've seen anywhere between 80 to 90%. 60 to 90, could be anywhere from 65 or 70% down to 40%. You get over 90 and it gets a little dicey. You get over 120, and a lot of people don't offer anything for the over 120 unless it's like a installment sale, or the people have worked out arrangements. We are typically able to negotiate something for a seller for the over 120, because if they buy it and they claim it as bad debt, they're going to get a write-off. So in our view, that it's got some value to it, but it's you know the quicker you can get it into the other buckets, the more money you're going to get.
Thank you, Steve.
Sure. And that should have been mentioned on COVID. It's another thing to watch out for. Is we haven't heard a lot of it yet, but the whole bad debt issue is something that could rear its ugly head, and you need to stay on top of that.
Well, right now we're in the middle of winter, so everybody's AR is looking just fine.
Yeah.
But that's every year, and I think we have to be careful not to fool ourselves into, what also happens every year in spring. And so, I appreciate the feedback. I've often wondered about how acquisitions are handled in terms of AR. So, thanks again.
Sure. The smaller deals tend to be collect and remit, if they have a good, clean account receivable. And from the studies we've done, the seller will get more money, collect and remit, but you're also taking the biggest chance, and you're not getting the money in your hand at closing. There's also a lot of paperwork involved, and you got to go through and you got to check stuff. To be able to get that cash at closing, even if you're taking a discount on it, is can be very desirable to a seller.
Yeah, and I'm assuming that, based on the ager, they're looking at the quality of the performance that is currently in place of, processes and procedures, and that is also taken into account.
Yeah, they talk about it as far as who does your collections, who does your receivables. They don't typically get into the weeds on how it's done, when it's done. I always remember I worked for a large multi-state market, and we had one particular branch division that always had really great receivables. And it came up in a meeting one time, and we found out that their collections people worked at night. It was just the simplest thing. Everybody wanted to work 8 to 4, 9 to 5. Nobody wanted to work that, till 6, 7, 8, 9 o'clock at night. But they had a couple of people that would rotate, and it's amazing how many people they got at home.
Absolutely. Unfortunately, technology is against us in that area these days. So
They know who's calling.
it really is, they know you're calling. But, you know, I, I think that, the value of your business is always based on, cash and sale and all the other things that you're so kind to represent here. And I appreciate you filling in that gap. Thank you.
Sure. Thank you. Appreciate the question. Okay. I appreciate everybody attending. If anybody wants to send an email with another question, feel free to do so. And thank you for spending your time with us today.
Thanks again, Stephen. We really appreciate the time you took today. It was really, really a great hour, and I appreciate you taking time to answer questions at the end. So thank you. We've enjoyed having you, and everybody else have a great rest of your day. We appreciate you joining us.